Good afternoon. My name is Teskey. I'm the CEO of Brookfield Renewable Partners. We know we're up last today, so we'll try and keep this punchy, keep it exciting, and end on a high note. Today, we'll start with an overview of our business and really focus on how our disciplined approach to execution and growth works across all economic environments. That will segue into Lluis Noguera, CEO of X-Elio, and Brookfield Renewable's Global Head of Development, who will speak to how our approach to development can be leveraged across the increasing number of development businesses we have around the world. Next, Vevaina will speak about how our differentiated approach to growth through M&A allows us to secure attractive value entry points. And then Wyatt will finish with our financial position and an outlook for the business. Over the last 12 months, let's say since we last presented here at Investor Day, there's two narratives about renewables. One is very, very positive. The tailwinds that have supported the rapid growth of the industry for more than a decade are stronger today than they've ever been before. However, equally, there are these dynamics of higher interest rates, higher CapEx, and a more uncertain economic environment that are raising questions around whether renewable power market participants can continue to grow as profitably as they have in the past. And we thought we would start our presentation by putting any concerns about Brookfield Renewable to bed. In the last 12 months, we've delivered record financial results. We've delivered record amounts of new generation from development. And we've had our single largest year for equity deployment into growth M&A. And we've done all of that while actually strengthening our balance sheet that already had the highest credit rating in the sector. And given the highly visible near-term outlook we have for the business today, we can say with confidence that next year we would expect to exceed a number of these thresholds yet again. So, financial results. We have continued to maintain our momentum of delivering double-digit FFO per unit growth, a trajectory we've been on for more than a decade. And given the significant investments in development, the dollars we have in the ground, new projects that are going to come online, and the significant amount of recent M&A that is now run rating through our numbers, we see a highly visible step change to a higher run rate level of earnings going forward. So let's talk about those development capabilities. In the last 12 months, we have delivered approximately 3.5 gigawatts of new clean energy capacity to global electricity grids. And the financial benefit of that incremental generation to our business is about $50 million of annualized FFO. Now, maybe just to put that number in perspective, when we presented that number last year, our level of development was generating about $40 million of incremental FFO every year. But if we take that same statistic and just roll forward from the end of Q2 to the end of the year, Q4 2023, we expect that number to be close to $70 million due to the continuously increasing amount of development activity we're doing around the world. And we are able to continue to deliver these successful high-returning development investments due to conscious decisions we made years ago to be in the best and most attractive segments of the market. Today, over 50% of our development pipeline is in the United States and benefiting from IRA. And over 90% of our development pipeline is in the most mature, de-risked technologies, notably solar, onshore wind, and distributed generation. This allows us to continue to deliver our projects on time and on budgets and target premium development returns well in excess of our 12 to 15% corporate return target. And we expect to begin we expect to be able to continue to scale up our development activities due to the significant investments in our pipeline in recent periods. It's not only the entirety of our pipeline, but the fact that we have high visibility of dollars we put in the ground that we will bring on almost 20 gigawatts over the next 3 years, and that by the end of next year, the end of 2024, we believe our run rate deployment into development will be 7 gigawatts of annual new generation online each year. But it's not just organic growth. As mentioned, we're also coming to the end of a 12-month period that has been our highest period ever of equity deployment into growth via M&A. And while the volume of activity is exciting to us, what's perhaps more important is the very attractive value entry points we've been able to secure over that period. We've been disciplined, we've leveraged our size and our global reach to focus on opportunities with limited competition where we could differentiate ourselves using something other than cost of capital. And those two major growth levers have allowed us to continue a very attractive financial trajectory. Over the last 10 years, we've raised our dividend every year, maintaining an annualized dividend growth rate well within our 5 to 9% return target, something we remain committed to today. And those dividend increases have been well funded by our increasing cash flows from operations due to that double-digit FFO growth that we think only accelerates going forward. And once again, we've done all of this without ever compromising the bedrock of our business, which is our balance sheet. Today, we maintain a strong investment-grade credit rating, and our focus on long-term, fixed-rate, non-recourse asset-level debt has ensured that we have minimal exposure to the current rise in interest rates. And when you leverage that against the fact that we have no near-term maturities and almost $5 billion of available liquidity, we continue to remain well-positioned to capitalize on any new or exciting market opportunities that come our way. All of this has continued to solidify Brookfield Renewable as a global clean energy supermajor, one that is differentiated by the fact that we are a major player in every major power market around the world, and we have market-leading capabilities across all major renewable power and decarbonization technologies. This allows us to continue to be the partner of choice for both governments and corporates looking to reach their decarbonization objectives. Maybe just switching gears for a second. In previous years, we've often dedicated a portion of this presentation to explain the strong macro tailwinds that support our industry. And these tailwinds have been very consistent for a number of years now. 1, accelerating decarbonization objectives. 2, renewable power's position as the lowest cost form of bulk electricity production. 3, the highly visible increase in electricity demand coming from large industries, notably industrials and transportation, that are increasingly electrifying and looking to get off fossil fuels. And 4, the role that renewables can play in providing energy security, an objective that is increasingly paramount in many regions around the world. Rather than go into each of these individually, we'd simply say that all 4 of these drivers have only continued to accelerate over the last 12 months. But there are many things that you read about in the headlines, and it's important to understand how these impact our business. So we thought we would run through a few of them. As you've just heard from the panel, there are many headlines about the growth of artificial intelligence. This is incredibly beneficial for our business. Artificial intelligence requires more data centers require more power, and the largest procurers of green power around the world are already the big tech companies that are now seeing a step change in demand for our product. There's been a lot of talk about inflation over the last 12 months, and we all recognize out-of-control inflation is not good for anyone, but central governments are doing their job and taking the hard positions to bring inflation back under control. But it's important to recognize within our business, over 70% of our contracts are indexed to inflation. So this period of high inflation has seen an increase in our revenues, and when you layer that on top of a high-margin business with a fixed cost structure, those increases in revenues drop straight to our bottom line. Higher power prices has been something that's been constantly in the news in recent periods. This obviously is a massive benefit for our business. Although we are mostly contracted today, about 10% of our business remains merchant, particularly within our North American hydros. And we are now seeing the opportunity to contract those assets at much more constructive power prices than we would have seen 3 or 5 years ago. And lastly, we've heard that access to capital has become more scarce and capital has become more expensive. Well, for many years, Brookfield Renewable's access to capital has been a key differentiator, and this has been particularly pronounced, allowing us to do deals and continue to grow in this market where others can't source the funding to continue to expand. So said another way, in the current environment, our competitive advantages have only been enhanced, and we believe the conditions for putting capital to work today remain excellent. And we thought we would finish by focusing on a few ways that our business is well positioned. For years now, we have been explaining how that our access to capital is a key differentiator for our business. In particular, how we can use our strong balance sheet and align it with institutional capital to do some of the largest and most attractive deals in the space. In the past 12 months, this has become particularly pronounced as we have used not only Brookfield Renewable's alignment with Brookfield's private funds, but also our ability to bring co-investors into our transactions, allowing us to target some of the largest and most attractive marquee assets that have been available in the market. It should come as a no surprise to anyone that some of our largest transactions have also been some of our highest returning, and that is why our access to capital is an enduring competitive advantage. And when you put that strong access to capital alongside our global reach with a boots-on-the-ground presence in over 20 markets around the world and our over 120 dedicated investment professionals, we can move quickly and with conviction and scale when we see large and attractive opportunities. Vevaina will give examples of how we've done that in the past 12 months to capture some unique assets that perhaps others would not have been able to execute on. One theme that we're increasingly seeing in our business today is the demand for decarbonization, and the trend line on transition is being much more driven by a corporate pull than it is a government push. In fact, the demand for green power and other decarbonization products is stronger today and far outweighs the supply of new projects that are available. But in order to capture that demand, you can't just have capabilities. You also need the capital to build out the projects, and most importantly, you need the assets. You need the projects, you need to have been investing in them ahead of time such that they are ready to build to step up and meet that new corporate demand when a counterparty is looking for new green power generation. And what we have been doing across our business for a number of years now is investing in best-in-class development capabilities, buying leading businesses in core markets around the world. And this has created a very virtuous cycle. Because we have global and scale capabilities to service the largest clients, we are increasingly capturing more of that demand, driving more of our growth, allowing us to invest in more pipeline, and increasingly positioning us as the partner of choice. That is a very difficult value proposition to replicate. And lastly, almost every year, we think it is incredibly important to remind investors of our operations-oriented approach to creating value. We leverage our thousands of in-house operating professionals to help in due diligence and ensure that we are making the most informed investment decisions. And then once we own an asset, we use those operating professionals to drive our business plans, enhancing and de-risking the cash flows of our underlying portfolio companies. But what we thought we would do today is go a layer deeper and focus on some of the key principles that we use whenever we are investing in growth. And we'll highlight a few of these. Whenever we are looking to deploy capital, either into a new organic development project or into an M&A opportunity, we underwrite conservatively and we target high returns. What this allows is when there are unforeseen headwinds in the market, we have cushion to a satisfactory outcome, but more importantly, there are probably a number of offsetting positives that weren't included in our underwriting that can counterbalance any unforeseen negatives and ensure that we continue to hit our underwriting returns. The second principle we wanted to highlight is something that we call removing the basis risk. Whenever Brookfield Renewable invests significant capital into an investment opportunity, we want to be sure that we can de-risk that investment right away. The best example of this is if we're going to invest in the significant capex of a new renewable project, we're only going to cut that check if at the same time we can lock in the power contract, the EPC, and the long-term financing. By locking in those four components at once, the returns on that invested capital are largely secured, and we are no longer exposed to changes in power prices, interest rates, or capex. And it is because of that that we can continue to deliver our development activities on time and on budget across a variety of economic cycles. When you put these approaches and these principles of our growth alongside our global presence and our deep local market expertise, we have a very repeatable business model for deploying capital at attractive returns. As such, when we sit here today, we have confidence that our recent investments, the returns are excellent and outperforming our underwriting, and we expect to be able to continue to deliver or exceed our return targets going forward. And as we have done in previous years, we are yet again increasing our targets into growth, now targeting $7 to $8 billion of equity capital into growth over the next 5 years. With that, I'll hand it over to Lluis Noguera, CEO of X-Elio and Brookfield's Global Head of Development.
Good afternoon. Today I'm going to talk about our differentiated development business model and also some of the lessons learned of my experience at X-Elio together with since the ownership of Brookfield. So first slide, two key messages here. I think the first one is 134 gigas of pipeline. As a reference, that's 2 times the peak demand of Germany, the largest economy in Europe. The size of our pipeline is 2 times the peak demand of Germany. Second message, really it's about diversification, as has been mentioned many, many times. When you look at the split of our pipeline, we are in all the key markets. The markets that already are committed to energy transition, the markets that have the regulation, that have the fundamentals, that have the economics, that make sense for this transition to happen. But we're also diversified in terms of technology. When you look at our pipeline, obviously solar is a big part of it. It's today the lowest LCOE technology in the market, but we're also in all the other technologies, especially in wind, and most of our wind position is an onshore wind, where the risk return today is the most attractive. But that is just also present in new technologies and storage. We're going to talk today about storage. Storage is taking a more and more relevance into our pipeline. So this page basically talks about 2 things. One, we set targets which we have consistently exceeded. When we look at our targets that we set for 2020, we exceeded them. When we look at 2021, again we exceeded them. When we look at 2022, again we exceeded them. And this is just not by coincidence. This is really the result of harvesting the effort that we've done through many, many years in investing in renewables in a methodic way, diversifying the risk that the development has, and being able to over and over exceed our expectations. How do we do that? Basically, we do that through our global presence, but with local expertise. Our business model is very, very difficult to replicate. We have the scale to really be a market leader, but we execute on a local basis. A very simple example, developing a renewable project in Texas is very different than developing a renewable project in Gujarat in India. We have a team that is an expert of developing renewables in Texas and a team that is developing renewable projects on a local basis in the main regions of India. That is unique, and that is what makes a difference for Brookfield. But let's look at the numbers. Today we have 31 gigas operating, but we have very good visibility of 18 gigas of near-term pipeline, out of which 7 are already or will be in construction before the end of the year. That talks about visibility. And that visibility comes again because we didn't start yesterday. We've been doing this for many, many years, and today what we're seeing is the results of our continued commitment to development of renewable projects around the world. With that, allow me to introduce a video that will talk a bit about X-ELIO. X-ELIO is one of the most solid renewables developers in the industry. We've been doing development of renewable projects for more than 17 years. We transformed the company from what was a small engineering shop into one of the largest global, diversified, multi-technology renewable developers in the world. We are present in all the continents around the world, from North America to Australia, from Japan to Chile, doing solar projects, but now also entering new technologies like energy storage.
It was 3 things that we really liked about X-ELIO when we originally looked at it. The first one was the fact that X-ELIO was a sizable, fully integrated development platform. Second, X-ELIO was present in all the key solar markets globally. And then third, it also allowed us to participate in the growth we saw in the solar sector as one of the lowest cost renewable technologies out there. So if you put all of these 3 things together with a strong management team and the strong capabilities the business had around contracting and procurement, that gave us a ton of comfort on the ability of X-ELIO to deliver on its growth plans. We set up a 50-50 co-control joint venture with KKR. Going forward, we will own and control 100% of X-ELIO, and that will provide us even further flexibility around the business in the future.
Brookfield has supported growing the pipeline significantly from the 5 gigawatts that we had originally to more than 14 gigawatts. From an asset rotation perspective, we have been selling over 1.5 gigawatts of operating assets in different jurisdictions. And from a funding perspective, we have increased the revolving credit facility on over $350 million to allow X-ELIO to be self-sustainable from a capital perspective.
X-ELIO is focused on developing green projects that are going to enable all the rest of the energy transition. When I think about green energy, I want to look at a partner like Brookfield that has been doing this for many years. I want to look at somebody that I know that is there for the long run, not just jumping into energy transition because it's in fashion, but somebody that has been doing this for more than 15 years, that has the delivery capabilities that Brookfield has proven over and over again.
When it comes to growth, X-ELIO has been doing a really good job over the last few years of building a really strong position in all the markets where they are present. And what that means today is that X-ELIO owns a very large and advanced development pipeline that provides significant growth visibility for the business in the coming years. The largest growth opportunity for X-ELIO is organically by executing or delivering on that development pipeline.
We want to produce the most demanded commodity of the next 30 years in a way that is sustainable, that is responsible, that takes into account all the challenges that we've learned over the years, and that's unique. Okay, so in that last picture, there was a tracker that was not facing the sun, so we need to work on that. Sorry, 17 years we've been doing that, and we were born engineering. We are engineers. So for 17 years, we started doing 5 megawatts projects, and today, by the end of this year, we're going to be building 1,500. 1,500 megas of solar around the world, from the US to Australia, from Japan to Chile. And I wouldn't say we've seen it all, but in 17 years, we've learned a lot. And we've learned many challenges, and we have the team that knows what to do, when to do it, and so on and so forth. Again, like I said, we are in many markets, the markets that really today make most sense in terms of competitiveness of solar, either markets that where solar is very cheap because they have the resources, or markets where solar has the economic incentives to actually be very competitive and very attractive for us. And we do that with a centralized team, centralized engineering, centralized procurement, centralized finance, but local development teams. In all the countries we operate, we have offices with at least 10 people, mostly engineers that know development and have been doing development, that all day are thinking about getting the right projects and getting them to the finish line and to start construction. So when we look at the numbers, actually the numbers there, what they show is quality. We've been able to sell 1.5 gigas, making more than 2 times on average. That is possible because of our business model. We develop from the land identification all the way to the notice to proceed. We do everything. We do the design of the project, we do all the permitting, we do all the local relationships, and so on and so forth. That means that when we develop a project, we think that we are going to build it. So we develop to build. We don't develop to sell. And that's a completely different mindset, because you don't get into trouble because you know your colleagues are going to be building that project, are going to be selling the energy, are going to be looking for the financing for this project. And that ensures that throughout all the process, quality is important, because we are not developing for third parties, we are developing for our own, we are developing to build. In addition, well, that asset rotation together with the 350 million of corporate facility, that again, I mean, if you're looking, the development is still a very, there are many developers, but when you're a bank and you look at who do you want to lend to a company that has been doing that for 17 years and it's owned by Brookfield. It's from a risk-return perspective, it's a no-brainer. So when you look at X-Elio today we have 15 gigas of pipeline on top of all the projects that we have already developed and sold, and 15 gigas is really the number. It's a number that is very solid. Again, visibility, visibility, visibility. Nothing is in our pipeline unless we have already secured land or interconnection or both. We are going to be needing many, many green electrons for the foreseeable future, but this pipeline is real, this pipeline is here today, and this pipeline is diversified. Again, we have more than 150 projects. Connor mentioned earlier, no binary risk. No binary risk. When you have 150 projects, you diversify the risk of development in a way that is what makes sense from a risk-return perspective. So what next? Continue growing, continue doing what we've done for 17 years. We are developers, we have a business model that has proven to be very profitable, we have the quality, we have the assets and the commodity that the world needs to actually get us there. We can do that in a self-funding model, and in addition, we are increasingly investing into storage. Storage is the next stage of the energy transition. We need a lot of green electrons, but we need electrons 24 hours. It was also mentioned earlier, and storage is the technology that is going to allow us to produce that. So X-Elio, I like to see it as a small Brookfield. A small Brookfield, again, if we think about 7 gigas per year, that's very difficult to replicate. Brookfield is doing that at a very large scale with the best developers in every region, best developer in India, best developer in the US, best developer in Australia, and so on and so forth. We are putting together a network of developers together with the scale and the capabilities that Brookfield has that is second to none. And we are applying on top of that the lessons that from X-Elio or from other platforms, we can move those lessons from one platform to another. If we see in a market that there's a problem and we see dynamics similar in another market, we can move those lessons from one market to the other. And with that, I leave it to Jeff to talk about some of the investments.
Okay. Hi, everyone. My name is Jay Vevaina. I'm the Chief Investment Officer in Brookfield's Renewable Power and Transition Group. In this section of the presentation today, I'll be speaking to our differentiated growth capabilities using examples that we've actually executed on. I wanted to first touch on a few points that Connor spoke to earlier to help to put our growth strategy and the advantages we have into context. Globally, there continues to be increasing decarbonization objectives from both governments and corporates. Government support continues to be strong, with the Inflation Reduction Act significantly benefiting our businesses. Increasing demand for energy due to global growth, acceleration of artificial intelligence, and energy security is driving renewable energy prices significantly higher. An additional key trend that is resulting in strong growth, and which Connor mentioned, which is very beneficial to our business, is the shift from a government push to a corporate pull. Corporates are increasingly setting net zero targets, making public commitments, and investing in businesses to achieve these goals. As of June this year, 47% of the world's 2,000 largest companies by revenue have stated net zero targets. And one of the most significant ways to reduce carbon emissions is by switching to renewable energy. We believe we are also best suited to manage through some of the challenges in our sector. This market dynamic that requires management of rising interest rates, access to capital, and supply chain constraints favors experienced developers such as us. Off-takers are keen to work with strong, reliable partners that have a global presence, expertise in complex development, and have deep operating capabilities. The examples I will speak to on the following slides demonstrate how we are differentiated and how we have navigated some of these challenges. The key criteria for our investment decision-making is the same as it has always been. Does the investment meet our target return on a risk-adjusted basis? We are confident that we can continue putting scale capital to work at our targeted risk-adjusted returns. With our unique capabilities, we are not restricted in the way we grow our business. We've had success investing in greenfield projects and acquiring very mature operating businesses, as well as everything in between. We also have flexibility to back high-quality management teams or integrate assets into our operations. The optionality to invest across the life cycle of a project allows us to review all deals in the market. The key message we would like you to take away from this slide is that the things that make us different provide us with opportunities that others simply do not have, and that is an advantage. The first point I want to make on this slide is our access to capital. The way our business is structured means we're able to bring in co-investors to participate in large-scale deals. Not only does this give us opportunities with fewer bidders, but it can also lead to strong partnerships. Bigger businesses attract better management teams and have more optionality to create value. Both Isahin and X-Elio were large deals that translated into 20% plus returning investments. Our track record and past experience allows us to find similar deals and earn outsized returns. On this slide, we have a few large deals that we executed on. Our track record has shown that we can constantly replicate our playbook and consistently create value with large-scale transactions. Our existing investments provide us with proprietary data and information that allows us to underwrite new acquisitions rapidly and accurately. We have a strong understanding of what is happening at a fundamental business level on the ground, and that allows us to act with conviction. For example, you may see us make several investments that look similar. This is because if we identify value levers, we can use that playbook to create value on more than one deal. For example, our 2018 investment in Lluis, the largest distributed generation business in the US, has been extremely successful, and we were able to drive margins higher than anyone expected. It is with this confidence and knowledge that it allowed us to invest in Standard Solar that focuses on a slightly different segment of the distributed generation market, and that investment is performing extremely well. In addition, we're highlighting our India platform. We entered the India market in 2017 and have been growing steadily since. Earlier this year, we signed our first major deals, committing significant capital with our investments in CleanMax and Nevada, materially increasing our capital in the region. We were patient, we learned the market, we developed strong partnerships, and then took action when the time and opportunity to enter was right. The key message here being that the investments we have made over the last decade provide us with irreplaceable data and knowledge that inform our investment decisions today. We can invest across the operating and development spectrum. In the examples here, we have 3 different investments in 3 very different stages of the life cycle. With Scout, we are advancing projects through development and into production. With Duke, which we expect to close imminently, we're taking a large established operating business, integrating it into our platform and generating additional value through our capabilities. And with Terraform, we've generated value through operating enhancements and commercial capabilities, extending contracts and executing tuck-in acquisitions. Double-clicking on our capabilities and the ways we generate value, our recently announced acquisition of Duke is a great example of how we were able to invest for value with significant upside potential. We were able to acquire Duke Energy's renewable business at an approximately 9 times EV/EBITDA multiple. Our credibility as a counterparty and capacity to underwrite and execute a scale investment quickly was integral to reaching an agreement with Duke, who was motivated to sell these assets and refocus the business on their utility operations. In addition, our ability to carve out a large business spread across multiple markets across the US was key, helping us to invest at an attractive valuation. We expect to execute on multiple levers for value creation from this business, from operating and commercial synergies, optimizing the capital structure, and growth from repowerings and development. In addition, we believe this situation is absolutely repeatable, and the market will present us with strong opportunities similar to this in the future. Our strong management and disciplined underwriting has been evident with our portfolio through the recent volatility. We continue to grow our FFO per unit at a double-digit pace and execute on our growth strategy. A great example of our ability to manage through headwinds is with our US distributed generation business. A recent analysis of some of the projects approved in late 2021 and early 2022 were developed through the recent period of interest rate hikes, and increases in CapEx are expected to perform better than they were in our underwriting. Strong cost management and the fact that we secured panels from suppliers well in advance resulted in no cost overruns. We were able to secure good PPA pricing above our conservative underwriting and realize upside from the IRA and also from financing structures. The key here being that we always underwrite to the downside, protect ourselves from adverse externalities, and position ourselves to realize returns at our targets or better. And I want to leave you with a final message, which is our track record has positioned us to continue delivering this high-quality growth. Thank you. I'll now pass the mic to Wyatt Hartley, our CFO.
Good afternoon, everyone. For those of you who don't know me, my name is Wyatt Hartley, and I'm the Chief Financial Officer of the Renewable Group here at Brookfield. And today I have 2 very simple but critical messages about our business. First, our balance sheet is strong, and we are well positioned to fund the growth of our business going forward. And second, our outlook to grow cash flow per unit is as strong as ever. Starting with the strength of our balance sheet, which Connor covered, underpinning all of this, we have a strong BBB positive investment-grade balance sheet, which is one of the highest ratings in the sector. In addition, over 90% of our borrowings are project-level, non-recourse, long-duration debt with very little exposure to floating rates, which translates well on a maturity basis with an average remaining term to maturity of over 12 years, and as importantly, no material near-term maturities. And finally, our liquidity is as strong as ever, with $4.5 billion available, providing significant financial flexibility to take advantages of periods of capital scarcity. And we also maintain access to flexible and diverse sources of funding to fund the growth of our business. When we finance our business, our focus is to prudently source our lowest cost capital. So this means we maximize corporate debt, preferred equity, or unutilized debt capacity at our existing assets while maintaining our investment grade rating throughout our structure. But it also means that capital recycling will continue to be an important part of our funding strategy, where demand for operating de-risk renewable businesses remains strong even in the current environment. As an example, over the last 12 months, we have completed a variety of sales across our business, crystallizing proceeds that on average represent almost 3 times our invested capital and generating meaningful capital to fund the growth of our business. Moving next to the quality of our cash flows, said simply, we believe we generate the highest quality cash flows in the sector. This comes from our largely perpetual and dispatchable asset base, our highly contracted profile with an average remaining contract duration of 13 years, and as Connor said, with 70% of our contracts linked to inflation, meaning our cash flows benefit in an inflationary environment. And as we have grown our business, we have also significantly de-risked our cash flows by increasing the diversity of our portfolio. Our current business is diversified across multiple markets and technologies, such that no single market represents more than 10% of our business. And as a result, we are well positioned to continue to deliver on our decade-long track record of annual FFO per unit growth of greater than 10%. And even compared to our update last year, the tailwinds across each of our growth levers continue to strengthen. Meaning, as I stand here today, our outlook to achieve FFO per unit growth in excess of 10% over the next 5 years is increasingly secure. And as a reminder, this comes from 4 basic building blocks. The first is inflation, which, as I said earlier, that almost 70% of our contracts are indexed to inflation, and given we generate at high margins and we use almost exclusively fixed-rate debt, our cash flows benefit from an inflationary environment. And as we look out this year, in an environment where inflation levels have remained above what most would have expected last year, we are positioned to benefit from additional FFO. And from a margin enhancement perspective, the expected benefit from increased demand for base load or dispatchable carbon-free generation continues to strengthen. As we walked you through last year, we have approximately 5,500 gigawatt hours of hydro generation that is rolling off short-term contract that will benefit from recontracted at much higher pricing. And as a result of an increasingly constructive all-in price environment, which includes the grid stabilizing features or the renewable energy credits that we sell from our dispatchable hydro assets, we are seeing additional potential upside to the annual FFO that we highlighted last year. And we continue to ramp up our development activities. As both Connor and Lluis highlighted, we take a de-risked approach to development that generates attractive risk-adjusted returns while delivering projects on time and on budget. And as a result of an increase in these activities to an annual run rate of 7,000 megawatts commissioned per year, the benefit to our annual FFO is meaningful. And finally, as Connor and Jay touched on, we are deploying capital into M&A at record levels into highly accretive transactions, meaning we have already secured growth that will contribute meaningfully to cash flow growth next year. So bringing this all together, with the additional tailwinds in our business, we are highly confident that all roads lead to growth at our most historic rate, delivering strong total returns to our investors. It won't let me, oh, there we go. So with that, I'll pass it back to Connor for our key takeaways and Q&A.
Great. So maybe just before we turn to Q&A, 3 conclusions to leave everyone with. We believe the growth opportunities for our business are as strong as they've ever been, and the current market environment really plays to our strengths. Secondly, we have a highly visible path to continuing our momentum of double-digit FFO growth well into the medium term in an already secured manner, and we also expect our recent elevated levels of growth to continue. And we do all of this without ever compromising on our 5 to 9% dividend annual increase target and our approach to delivering strong, attractive, risk-adjusted 12 to 15% returns on our deployed capital. With that, we would like to open it up to questions.
Hi, it's Ben Pham, BMO Capital Markets. First question, the $7 to $8 billion targeted equity deployment number that you put out, what percentage do you think has been de-risked or more visible to you vis-a-vis the development activities that you have planned out?
Yeah, it's a great question. Of that 7 to 8, it's probably safe to say about a third of it sits internally within our pipeline, opportunities that are proprietary to us to deploy capital in, and the remainder is incremental M&A.
Thanks. And maybe the second one, there's the conversation around AI technology companies, and the theme we've seen in the last few years is they outsource companies like yourself to build renewables. As you think about the next 5 years, do you think that there is a risk to you in the industry that they would just build those projects themselves, that they become a fierce competitor to Brookfield Renewable?
It's an interesting question. Candidly, we think the answer is no. As Lluis mentioned and as Dan mentioned in the panel discussion, development is a highly complex local process. It takes a lot of people. It takes a lot of experience. What we have to be able to deliver our large-scale power on a global basis is very difficult to replicate. And personally, I don't think it's the key objective of the large tech companies. They're focused on growing AI, cloud, those types of products that they are best in class in.
Anthony Crowdell, Mizuho. It seems right now that it's a buyer's market for renewable projects, particularly in the United States, and especially if you look at offshore wind right now. I guess my question is twofold. One, do you see that buyer's market changing for these projects? And two, your view, does someone step in to acquire these offshore assets, whether it's merchant or regulated? Thank you.
Certainly. So maybe just to make a comment regarding offshore, we love offshore. We think offshore is a great technology. It can be produced at scale. The fact that it's out in the ocean addresses some concerns that often people have about building solar on land. So we are big believers in offshore. And the only reason we don't have greater exposure to offshore today is because of our discipline to adhering to that principle of we don't take on basis risk. Many of the opportunities to invest in offshore historically, you had to commit huge sums of capital up front many years before you knew the cost of building the project or the revenue that project would attract. Increasingly around the world, projects are closer to development, they're closer to construction, and it's going to create opportunities for us to invest without taking on that basis risk that we've historically been averse to. The second comment just about the type of market it is, we often get the question, is it a buyer's market or is it a seller's market? It can be both at the same time. There is no doubt today there are more attractive opportunities to buy large-scale platforms that are complicated and have significant opportunity for value enhancement. That is the bread and butter of what we do when we make large-scale M&A acquisitions. But what we wouldn't want to leave you with the impression is that there isn't a very, very robust market as well for de-risked, high-quality, mature, contracted operating assets. And that really feeds into our asset recycling model, where we can be investing at very attractive returns into new investments, while at the same time, in the same market, selling de-risked, mature assets to lower cost of capital buyers at the same time. So maybe we will cut it there, recognizing we are last, and I actually think we outperformed and saved a little bit of time. Just lastly, on behalf of everyone at Brookfield, we'd like to thank you all for coming today. We appreciate your interest and support of our listed issuers and our affiliate entities. Because the weather is good, we have moved drinks from inside to outside on the patio, and we look forward to seeing you there. Thank you.